Welcome to our live Q&A. So we'll have an hour together and we can talk about markets and you can ask me questions about anything you like, as long as it's to do with markets. And we do have a couple of announcements. We have a special offer this month, which is for our membership on our website. So if you'd like to try it out, what we're going to do is offer a special discount for 1 month only. So you get 75% off your first month's subscription. And if you want to do that, use the code SAVE75. And if you apply that when you sign up for our membership, you get that 75% discount off your first month's subscription. And this is really a chance for you to try it out, I guess. But a lot of people choose to stick with us because they find the membership useful. And of course, you've got access to chat. You can ask questions whenever you want. You've got a huge library of explainers, which I've made over the last several years based on member questions. And we also have trackers and an app, which we're developing and improving. Actually, there are some exciting things to come there as well. So coupon is SAVE75, all one word, uppercase. And to use it, just go to PensionCraft.com/membership and you'll see there's a place to enter the membership. Anyway, so we'll have an hour together. Maybe a good place to start is to talk about markets because that's what we're interested in. There's been an announcement today that Trump and President Xi have agreed to launch a new round of trade talks. So that's obviously a positive, but it's removal of a negative. So is that a positive? Yeah, relative to where we were. So it's kind of good news. I don't know whether markets have taken it well. I haven't had a look at markets today. I've been making a video. Let me have a quick look. So let's have a look at NASDAQ. Let's have a look at SPY, the S&P tracker, just to see how that's reacted. I assume it's positive. I mean, we're pretty much back to where we were, remember. So let me share. So this is the NASDAQ index, and you can see that the index itself, not NASDAQ index, this is the S&P tracker SPY, and it's only about 2.4% off the previous high now. So getting expensive again, driven by the Magnificent Seven again. So it's pretty much back to where we were before all of the trade war fears really started to kick in. So I think, the taco trade, as it's called now, thanks to the FT, it's kind of got famous now. I don't know if you listen to Robert Armstrong's podcast with Katie Martin called Unhedged, but they've been talking about this quite a lot, and he's quite worried that because he's coined the phrase the taco trade, Trump always chickens out. Trump heard this at a press conference and he said it was nasty, and he immediately increased the tariffs on aluminium and steel. So maybe that was a reaction to Robert Armstrong's new acronym. But you can see that generally when the market really pushes back, particularly the bond market, the treasury market, you can see that Trump has backpedaled on some of his more extreme policies. The next worry, I think, is that there's going to be a problem with US treasuries because we've seen that there's been a huge amount of issuance. There's a question of whether this new big beautiful bill is going to expand the deficit even further, which means that the US will be piling on debt even though the debt to GDP is now very high, 120% of GDP. So piling debt onto that is going to be problematic potentially. But not a huge amount below where we were before the big sell-off occurred. So back to where we were in February almost. So I guess we are kind of in a positive place right now. If you didn't sell, you're probably feeling pretty smug. If you bought when there was a dip, you're probably also feeling pretty smug. So a recovery in risk appetite. But I think the difficulty now is, where do we go next? Is it the case that the big beautiful bill will be hugely positive for growth, as Trump says, Or is it the case that we're going to now start to see the effect of tariffs and it's going to be vastly negative on growth? So very different views depending on your political persuasion. Personally, I think I'd probably go for the damaging effects of trade, because I think it is going to be a problem for many US companies if tariffs are imposed, and it is seen as a brake on economic activity, because if companies have to raise their prices, that is inflationary. We are starting to see a weakening in job growth in the United States. So perhaps there is a weakening of the economy as a result of the tariffs. But as always, we're just going to have to wait and see what happens, and just trust that the data is reliable, which maybe it isn't anymore. Anyway, back to your questions, and let me go back to that. No. Back to that. There we go. And Laura's got a document for me. So if you do ask a if you do a super chat, then obviously we benefit from it. So please do ask a super chat if you want to ask a question. We'll push your question to the front of the queue. And I see there's one already. That's great. And if you're a supporter of our channel on YouTube, also you get pushed to the front of the queue. So please do that. Yeah, Laura's got a nice description of the member benefits, which I didn't do very well. It says an extensive library of members-only videos. I did mention that. A tools app to create investment strategies and backtest them to evaluate potential returns and risk. Chat forum, I mentioned. And say others, but don't have to list them. There we go. So I think I didn't do that very well, as you can see. Right, anyway, so thank you for the super chat. And the super chat is from Blimp, I think. And the question is, there was an article in the FT this morning about big investors shifting from the US to Europe. Does Europe seem more appealing to you? It's more appealing than it was. I think the problem at the moment is there's a big debate about American exceptionalism. Is it the case that the US will continue to power ahead in terms of economic growth, in terms of corporate earnings, in terms of market cap dominance? Or is it the case that the US is now kind of fizzling out in terms of its economic growth, but also its leadership in the world of technology, its leadership on the political stage, because it does seem to be going more insular, and that's largely because of the mandate of President Trump. He's been chosen to do these things, reducing immigration, this war on universities. I think that's hugely damaging for the US. A lot of researchers in the US are thinking about moving elsewhere where there's greater freedom of research, where they won't be persecuted almost for their beliefs. That's pretty shocking. So I think a lot of these changes are negative for growth. So that's my worry. And the one about academia in particular, which is close to my heart because I was in academia for many years, and I think you've got to have that freedom. And if the freedom starts to be eroded, if you have this war on universities like Harvard, well, it's actually the crown jewel of American intellectual achievement. You've got so many presidents who've been there. You've got so many foreign presidents who've been there. And stopping foreign students from coming there is very odd. I mean, and damaging, I think, for the US's reputation. So that's a problem. The tariffs themselves, I think, are a problem. Taking your allies and sticking a huge tariff on them, that's a problem. So I think that's my worry. And I think if it continues, if there aren't taco effects, if there isn't a negative market reaction and Trump doesn't back off, then I think it's going to be a very damaging presidency. And of course, we're only now 4 months in to the presidency. We still have over 3.5 years to go. So it's really a question of, is he front loading this stuff at the beginning and then will he just coast for the rest of it? Or is it going to be this level of change continually for 3.5 years? which I think the market would have a very tough time digesting. So big worries at the moment, I think, are things like US debt, almost a kind of disregard for US debt, and this old trope, which is that if we cut taxes, there'll be greater growth, which historically has just not been the case. If you cut taxes, you reduce your revenue. If you reduce your revenue, you have to reduce spending, otherwise your fiscal deficit increases. So that's really the question. Is fiscal irresponsibility going to push back? Will there be a spike in US yields if people don't want to buy US treasuries? If so, that could cause a problem for the United States. Will there be a problem in the credit market as a result, because the all-in funding costs for companies would increase as well? So all of these are things which I worry about and which are a direct result of these policies. At the moment, we're back to kind of everything's fine. If you look at credit spreads, everything's fine. If you look at US valuations, it says everything's fine. But everything is not fine. And we'll have to wait to see the economic data, which takes longer to feed through, to see how bad things are. Or if they're bad at all. Maybe there isn't a negative effect. But do I like Europe? Yeah. There are certain sectors in Europe which are doing very well. Defence is doing very well. If you look at the returns year to date, Europe is outperforming the US, which is very unusual. Will that continue? I think it might do, actually, because we're just waiting until the next utterance from Trump, which is going to be market negative. That's the way it feels every day. I wake up, I look at the headlines, and I think just, what's next? What other madness are we going to see? So I think that's my worry. Europe, on the other hand, is quite boring. It's quite staid. It doesn't have the excitement of the US market, but in this kind of environment, that's seen as a positive. And certainly things like my European defence portfolio has done very well. It's up about 30%, and it's still powering upwards. Now, for bad reasons, obviously, because Europe's worried about Russia, but that sector's doing well. But broadly, if you look at the DAX index, yep, that's doing well. And many European indices are doing well this year. So I think, yeah, I still like Europe. It's very cheap relative to the US. That's still the case. It's a place where you find stability, also seen as a positive. And I think a lot of Europeans are really questioning their US overweight, if they've got one, and whether the market cap weighting is justifiable given what's going on. And I think many European fund managers have decided that the overweight is not justified. Personally, I'm sticking with my global market cap weighted index, but I have seriously considered moving away from the US, or at least tilting slightly away from the US because of what's going on. But I haven't yet. Okay. It takes a lot to make me shift, because the simplicity of a single fund for me is very valuable in terms of controlling my own behavior and not trying to fiddle with the portfolio. Whereas if I had 3 different regions, developed ex-US, US and emerging markets, well, you're always thinking, well, should I tilt back? Should I tilt away more? Should I have it in EM or DM? There are all these things you have to think about. Whereas with one fund, I never have to worry about that. I don't even think about my core holdings, even though it's 90% of my investments. So, yeah, I think Europe's interesting. I think developed ex-US is interesting, which isn't just Europe, of course. But, yeah, I haven't tilted away. So it's not interesting enough to make me shift away from a simple market cap weighted portfolio. Next question is from Amir Ketobjeet. Nice to see you, Amir. He says, keep up the good work. Are you getting worried about the US, all the debt, the crazy politics, the slow decay? And is there a way to invest in Chinese EVs? Well, you can always invest in, there are Chinese tech funds that you can invest in. And I suspect if you go for a Chinese green technology index, like, I think there's a Crane Shares Renewable China. Let's see what we've got from Crane Shares. I know it's got several. There's an internet one which I lost money with before. I haven't had a great experience of investing in China. There we go. Yeah, I accepted all. Yeah, so KWeb is this China Internet ETF, but there are also other. Let's look at the other China. So there's China Healthcare. So if you think that there's upside in China's investments in its healthcare system, then yeah, that could be interesting. Clean technology is the one I was thinking about. Let's just see what's in that. And I suspect it's got a lot of KGRN, K Green. Let's just look at the top holdings in that. Yeah, so it does have things like XPeng in it, BYD. So yeah, it does have NEO. So that's maybe one way to do it, a kind of simple way to do it. And there are various listings of this ETF on multiple exchanges across the world, so it's pretty easy to buy. I wonder if it's got a list of the exchanges. Don't think it trades on the London exchange. Yeah, it doesn't list it, at least. Prospectus, no. Anyway, too risky to do that live. But that's probably the simplest way in fund form to access that. So that wouldn't be pure EVs. It would give you a big slug of EVs. But I'm not aware of a fund which explicitly gives you exposure to Chinese EVs. If someone is aware of that, just say in the chat, because I'm sure everyone would be interested in that. But is China? I think what's kind of interesting at the moment. I'm just doing the explainer for our members on China, and also the kind of changes, the 5-year plan which they've got. What's really interesting is they have these 5-year plans. They have the 10-year plans, which they pretty much stick to, and the government invests this way. Local government invests that way, and government and industry work together to achieve the plans. Whereas if you look at what's happening in the US right now, there's a big shift away from green technology, an explicit move away, when the rest of the world's moving in the opposite direction. So in a way, this is just like, giving a passport to China to utterly dominate that space even further. But previously, they invested in things like rare earth metals, which would feed into this technology, and they control the entire supply chain for those. Which is actually a very prescient move by China, and now the US is left struggling to catch up. Also, we've seen dominance in the clean energy space, electric cars, as you say, EVs, Emir, and also solar panels. They've really dominated that space. There's overproduction, you could argue. So maybe they've been dumping products onto the rest of the world, but it's still, they've been very successful in their model where the government works with these 5-year plans to achieve certain technologies and dominate certain technologies. So I think, yeah, that's definitely an interesting thesis. If you are going to bet on those, then there are ETFs which allow you to do that. Some people are worried that some of those are ADRs. These are stocks that trade on the US stock exchange, which give you exposure to Chinese stocks. And the worry is that there won't be a proper linkage between those two, or that the US government is going to make it so that those are untradeable. So that is a worry. But some of these automatically, or not automatically, they've decided to go for the Hong Kong listed version of those stocks rather than the ADRs. And Crane Shares says that that's what they can do if there is a threat of removing the ADRs. So I don't think that's a huge risk, but it is a risk if you go for those ETFs. But anyway, Crane Shares says they can switch to the Hong Kong listed stocks quite easily and give you the exposure that you're after. But what is kind of worrying is we're seeing things like Section 899, which is looking like it's going to be a war on capital flows as well as trade. So that is quite worrying if the US government goes through with it. But hopefully that won't happen. Next question is from Good Q. $100. Gosh, thank you very much. He says, caught you live. This super chat is for this and the last 4, including the ones during the market turmoil. Took me a while to catch up. If you feel like it, you can also tell them you're a physicist. I give you permission. Hope that guy's listening. Every time though. So, I just mentioned, I think, one time that I'm a physicist, and I think it was in one of my videos, and then I had this nasty comment. Someone said, you're always dining out on the fact you're a physicist, and then there was some kind of nasty comment that went with it. But a couple of people that went to my old university, Imperial, actually said, you should say it more. If only to goad that guy. So, yeah. Well, thank you very much, Good Q. And thank you very much for the super chat. I appreciate it. And thank you for letting me say I'm a physicist. I'm still quite proud of the fact that I did a physics degree and a doctorate as well. Anyway, thank you for that. And the next person is Philip C., who says, what do you think might happen if 95% of the stock market becomes 95% passive? I think it's unlikely to happen because imagine that the market did become very passive in terms of the flows and the stock of passive funds. At the moment, I think it's still, like 55% of the money that's managed is passive. So it's not quite the case that, it's vastly dominating the market. But it would be more, it's still the case that if you had, say, 10% of the market trying to actively choose stocks which are going to outperform, if that was the case, then you could still get stocks outperforming as a result of good fundamentals. And remember, a lot of passive funds, or so-called passive funds, are now fundamentally weighted. So they go for things like value, quality. And if that's the case, then it's kind of like stock picking. It has the same effect, which is it buys and sells on the basis of fundamentals for the company. A value fund won't buy a stock that's overvalued based on price to book or price to earnings or whatever the metric is it uses. A quality fund won't buy a stock which is overlevered or which is not growing its earnings or which has a low return on equity. So in that way, passive funds, even if it was 100% passive, these are kind of semi-passive funds in the sense that they have a rule that they follow, but it's not tracking an index per se. It's more tracking a set of rules. So I think that's more likely the way we're going to move. I think a lot of these funds now blur the lines between active and passive anyway, like these rule-based ones, these factor funds. Are they passive? Well, the fees are low, like a passive fund. Some fund managers now also, which is kind of interesting, like Wisdom Tree, for example, with their European Defence ETF, they've actually created their own index, which they track. So is that passive? Because they created the index. It's rule-based. There are certain rules as to what goes into the index and how it's weighted. How much of the revenue is generated from defence. So they have different groups for that. And then something which has a higher amount of its revenue from defence will have a higher weighting. So you're getting the exposure you want. But there are also ESG criteria. So cluster munitions, if a company produces those, that's not included. All of these things go into the index. Is that passive? Is the S&P passive? It's actually a committee that decides what goes in and out. There are rules, of course, for the initial listing on profitability, for example, but ultimately it's a committee that decides. So I think it's a kind of blurred line. So that's my roundabout way of saying, yeah, I think even if the market was 95% passive, you could still have a situation where fundamentally good companies float to the top of the tank and get bought. And so there's still price discovery, or fundamentally good company discovery, I guess is the way you describe it. So, yeah, I think passive is a kind of very broad church. And that's why I don't think it would be a problem if 95% of the market was passive. And I think we are moving that way. I think the way we're more likely to move is that people will have their own personal AI, which does indexing based on their requirements. Because remember, the reason why active funds often underperform is not because they don't generate alpha. A lot of them do generate outperformance relative to passive indices. It's just that the size of the alpha is quite small, and the additional fees that they charge gobble up the alpha. So if you could have your own robo AI that would be choosing the stocks, choosing the asset allocation, choosing the duration, choosing the credit quality of the investments, then if the overall cost of running the AI was low and it didn't churn too much, I think that could quite reasonably be the future of what investing looks like. In fact, I'd say it's pretty likely we're going to go down that route. And it's just one step up from direct indexing, which was a similar concept. A lot of people thought direct indexing would kind of get rid of ETFs. So instead of having an ETF where everybody buys the same index, you say what your criteria are. I want companies which are maybe market cap weighted. I want you to exclude companies with the letter Q in their name because I don't like the letter Q. Whatever your criteria are, you put it into the index, it generates it dynamically. It could be based on fundamentals like quality, value, momentum. It could be based on tilts. It could just be market cap weighted, but you get whatever you want. So I think this AI approach would just be one step beyond that. But I think that's more likely to be the way we go. But that's just my guess, right? Next question is from Luca Paradis, Photography London. Thank you, Luca. And they say, I was thinking to buy gilts with long duration, assuming the probability of interest rate drop or a market downturn are quite likely to happen. What do you think? Well, it's funny, in the community we always joke that long duration gilts are like cryptocurrency for old guys like me. So it's kind of, it's very volatile like cryptocurrency. You're taking a punt on what's going to happen to yields. You're essentially betting that yields are going to fall, which is what you're saying. Do I think yields are going to fall? I have no idea. But look, what is it that drives long-term UK yields? There are lots of drivers, but primarily it's growth expectations. So if growth expectations fall, the price of long-dated gilts goes up. If inflation expectations fall, the price of long-dated gilts goes up. So either of those would make the gilts increase in price. So that would be lower expected UK growth, lower expected UK inflation. Both would be positive for long-duration gilts. And then, of course, there's the worry about supply and demand, right? So is the government going to have to supply lots of new debt to the market because it's got a big fiscal deficit? Well, this government that we've currently got is very strict about its fiscal rules, so it's unlikely that's going to happen. If it was a problem, I think the Bank of England would probably slow down its QT program. There's talk of that already. Oh, right, time for Teddy treats after this question. But I think. Is the UK growth going to disappoint? In fact, what we're seeing is a little bit the opposite. People were so pessimistic about UK growth. It's actually looking pretty positive, or at least not as negative as it was. So that's going to push yields up and prices down. That's a negative. Inflation is falling, which again is pretty much in line with expectations with what the Bank of England's been saying. So that's a fairly neutral one. Remember, it's always relative to expectations. And then finally, Is there going to be lots of bond issuance? Probably not at this stage. So, that's going to keep yields lower. So, one positive factor, the issuance dynamics, issuance redemption dynamics. And then the other two, positive growth is not good for gilts. So if we carry on getting these positive data surprises for UK growth, which I know some people, it's still fashionable to be negative about the UK, but I still think it's quite positive potentially. A lot of the policies that the government's got at the moment are, of course, about increasing growth. It takes a while, but I think, they're doing their best. I personally wouldn't have a big bet on UK gilts from this point. I don't think there's a big driver of yields falling. For the US as well, the US is probably going to drag yields higher if we have a US Treasury accident. It usually drags our yields higher, and that would be my worry. We might be absolutely fine, but the US might have a Treasury accident. Trump says he's going to default on US debt, or he's going to question central bank independence again, and that'll push yields higher, and that'll be bad for UK gilts, even though we've done nothing wrong. So that would be my worry. So, just be honest about whether you can call it correctly, Luca. And I'm not sure I could. So that's why I usually hold my gilts to maturity. Then you don't have to forecast anything. Anything which requires you to forecast is speculation. Whereas if you buy a gilt and hold it to maturity, you just earn the yield to maturity, roughly. There's a little bit of a leeway, but that's why I hold to maturity. So, long dated gilts, I don't touch them. It's speculation. It's Bitcoin for old guys. Okay, so I don't do that. Anyway, let's summon the dog at this point. So this is half time. And I've got new treats actually. I've got these burger ones. He loves these. So I only give him one a day. So today's a very special day because he's going to get two. But I have to feed it to him in bits because I don't know if you can see. It's like a kind of... Actually smells like a burger. God, those other treats were disgusting, weren't they? I don't know why I gave you those. I'm so sorry. So I kind of put a picture on Blue Sky of him today. We got caught in the rain and he looked very bedraggled and very sorry for himself, didn't you, Ted? Is that good? Oh, his tail's wagging. I wish you could see it. One more. Yes. How's that? You enjoyed that, didn't you? You weren't expecting that. I usually give him these kind of low-fat ones, but you can have one of those as well. Just one treat, Ted. And then you can go back down to your biltong. Biltong with Laura. There you go, mate. One more. Yes. Good lad. Brilliant. That's it. It's all gone. All gone. So you looked like you'd had a perm today because we both got caught in the rain. We were both quite bedraggled. You're going to go down. Go back to Laura. Back to Laura. Good lad. Yes, he's off. Oh, and I can mention that, couldn't I? Here we go. So this is our... Oh no. Today's episode is... this is our podcast, Many Happy Returns. You can listen to it on YouTube or on Spotify, Apple Podcasts, wherever you get your podcast. And this one was about Section 899. I don't know if you're aware of it, but in this big, beautiful bill, which is thousands of pages long, markets have somehow managed to glean this Section 899, which is effectively going to put a increased tax on dividends which are paid out to foreign investors. So the details aren't clear at this point. So for example, if you own an ETF which is domiciled in Ireland and you're a UK investor, does that mean that you're going to have to pay based on the Eurozone's policies or on the UK's policies? If you go for a synthetic ETF where you don't usually pay withholding taxes. How's that going to work? It's not really clear what's going to happen or how this is going to be, how it's going to work. But it's certainly rattled people, justifiably, I think. If dividends make up a big proportion of returns over the long term, not so much for the US because it only pays out a dividend yield, I think it's 1.5%. So we're talking about, adding at most 30 percentage points to the existing withholding tax. And if you own an Ireland-based ETF, the withholding tax on US dividends is currently 15%. So if we add another 20, that goes up to 35. But it's 35% of that 1.5%, which you'd end up paying. So incrementally, it doesn't sound huge, but if it exists for a long period of time, it could be a huge negative drag on US equity. And I just think it's a mistake because it's just making US equity even less attractive to foreign investors, and that's not what you want to do at the current time, right? That's not presumably what you're trying to achieve. Anyway, that's a bit of a shock. So anyway, if you want to hear what Michael and I have to say about it, have a listen to that. And back to your questions. Luca has another question. He says, thanks for your answer. My strategy is choosing one that pays around 4% coupon and in a quantity I can keep till maturity if things go wrong. Time for teddy treats. Yes. Let's have a quick look at the yield curve just to kind of illustrate your point. So again, if you're a member of our community, we've got these trackers, and let me show you what that looks like. So you get this dashboard as part of our community, and you go to the trackers, and we're kind of adding to these all the time. But we have a gilt table which lists all 63 gilts which are currently outstanding, their yields, and it puts you through to a calculator for yield to maturity. But this is our bond market tracker. So this is the UK yield curve. On the x-axis you've got time to maturity, the y-axis is the yield to maturity, and the size of the blob tells you how tax efficient the bond is. So a bigger blob is more tax efficient because a larger proportion of the return comes from capital gain, which is not taxed in the UK if you hold it outside an ISA or a SIP. If it's in an ISA or a SIP, you don't really care. So you can see these are the low coupon ones. The coupon there is just 0.3%. So I think what you were asking is about which one would be interesting to buy. Let's go back to your question. The strategy is choosing one that pays around 4% coupon and in a quantity I can keep till maturity if things go wrong. Yeah, the good thing about a gilt is, unlike a cash deposit at a bank, is you can sell it in the secondary market, which you can't do if you've got a cash deposit with a bank because you're usually locked in for some period of time. But if we zoom in on the shorter end of the curve, these are the ones up to 10 years, which you could probably hold to maturity. The yields aren't too bad, not great. The dashed line you can see here is the SONIA rate. Now that's the Sterling Overnight Index Average. That's the rate which you'd earn if you had a money market fund. And I put that in because one of our community members asked for it. We do listen. So this just allows you to compare what you'd earn with the money market fund with what you'd earn with a gilt. So for this one, for example, once you go out to about 7.7 years, the yield to maturity exceeds the money market rate. And of course, the money market rate is variable, whereas you lock in the yield to maturity on the day you buy the gilt. So these are probably attractive. Even the ones which are a little bit below the current SONIA rate are attractive because the Bank of England's on this downward trajectory. Yeah, there are going to be fits and starts as the data varies and the stickiness of inflation, opinions about the stickiness of inflation vary, but we are on a downward trajectory. We'll probably end up at around 3.5%, eventually, once the scares about inflation spiking go away. But any of these are kind of attractive, but you have to go out to about 6 years, which for you is probably okay. For me, lots of grey hair. Am I going to make it? 6 years, probably. But it is a bit of a worry when you get to a certain age. But any of these held to maturity, the higher yield ones, yeah, I think that's pretty attractive. Anyway, that's our yield tool, which is quite useful. And the gilt table is also useful because it tells you can drill into the individual gilts and see which ones are tax efficient. So you can either sort by coupon, so we could go for a maximum of 0.5% on the coupons, or we could look at something called the gross equivalent yield, which is quite useful. So gross equivalent yield is the yield a taxable instrument would have to earn to match the yield on a capital gains tax-free gilt. And that's assuming you're a 40% higher rate UK taxpayer. So really this is saying, given your tax band, what would you have to earn on a money market fund, say, to match the yield on this gilt? And for the low coupon gilts, that gross equivalent yield is high. So for example, this one, TG61, the yield on a money market fund would have to be 6.65% to match the net yield of this gilt. So yeah, it's unlikely you're going to get this kind of rate, 6% for example, that you get with the gross equivalent yield for this TN28 bond is 5.96, so about 6%. So you'd have to earn a very high yield on your money market fund or your bank deposit to get the same net yield as this gilt held outside an ISA or a SIP. So anyway, I think that's quite a useful calculator when it comes to buying gilts and working out which ones are tax efficient. So a lot of our community find that helpful, and we do modify it based on feedback, which is also, I think, a good thing. We have recently done a members survey, and we're actually working through some of the feedback we've had, and there's a lot of great feedback. So if you do run a community yourself, I strongly recommend listen to what your community tells you. Anyway, and that was Laura's initiative. She's actually the one that was behind that. She's an absolute star. You don't usually see Laura, but she's the kind of unsung hero behind the scenes who makes everything work and keeps me on track when I digress. So, so you've got her to thank for that. Okay, some more super chats. Thank you. FZIX Kid. I can't pronounce that. Physics Kid, maybe. Physics Kid says, what are your thoughts on the continued GBP strength, sterling strength against the dollar? It's affected my returns, mine too. And I assume yours too, as you're in VHVG. Yeah, not just VHVG now. I've also got ACWI, which is the State Street Global Equity Fund, because on Invest Engine, which is now where most of my SIP is, I've got a wider choice of funds, and I've gone for a global fund, which is ACWI. But as you say, that's affected by sterling. So let's have a look at sterling. It is pretty shocking. GBP USD. Here we go. So this is sterling versus the dollar. Let me just do something. So you can see if you go all the way back to 1975, it was like $2.4 to the pound. Now it's more like 1.3. But if we zoom into the post-Brexit period, so 2016 was when we had the referendum, got a massive weakening of sterling, and it's been bouncing around in this range of 1.24, briefly down to 1.08. Let's talk of parity for a while. But recently it's definitely been on this strengthening trend versus the dollar. And this isn't sterling strength, this is dollar weakness, right? That's the shocking thing. And it's just like an upward trend, right? There's really been very little reversal of it. And this is despite the fact US yields are high. Now that's the scary thing, because usually currency movements are driven by interest rate differentials. High interest rate in this country versus this country means that capital flows from the low interest rate country to the high interest rate country and strengthens its currency. That's the gist of it. At the moment, what we're seeing is US yields are high and getting higher, and at the same time, its currency is weakening, which is really shocking. That is, I think, the most worrying trend we're seeing at the moment. So the dollar's not seen as a safe haven. When US stocks sell off, the dollar doesn't strengthen like it did historically. Now, that was great as a UK investor because it meant that it kind of dampened the volatility of your US investments or your global investments, which are dominated by the US. What we're seeing right now is not dampening volatility. It's actually amplifying the volatility. And that's a worry. This has reduced the value of our funds. So while the NASDAQ and the S&P have almost recovered, if you look at my global equity fund, which is ACWI, you can see that it hasn't. So it's still down by, 6% below where it was. So it's being driven higher by strengthening US equity and European equity, of course, but it's being dragged down by dollar weakening, and that's a problem. But look, you can't forecast these things. Let me also pull up something which you may find interesting, which is a post I had on Blue Sky recently about purchasing power parity. Yeah, a couple of things here actually which you might find entertaining. So this is Teddy looking bedraggled after we got caught in the rain today. This is Meet Kevin, who's just shut his ETF. Generating alpha is difficult, it turns out. This is the post I was thinking of. So this is the OECD purchasing power parity estimate for sterling versus the dollar. Now, for a long time, this looked crazy. The way this works is you take a basket of goods, which is equivalent in the US and the UK, and you say what currency exchange rate would make this basket of goods in the US equal to the value of the basket of goods in the UK. And that answer was 1.44 for the 2024 PPP model from the OECD. Now that seemed crazy for a long time, but what we're seeing right now is such strengthening of the dollar, such strengthening of sterling versus the dollar, that it suddenly seems realistic that we could get to 144, which is the PPP estimate. So that's the world we find ourselves in. But anyway, yeah, PPP from the OECD at least is 1.44 for sterling versus the dollar, which is pretty shocking. But you're right, it's affected my investments just as it's affected yours. Will it continue? I think if the policies don't change, yeah, it's going to continue. If we see fiscal irresponsibility, if we see denial of economic truth, you can gaslight people, but you can't gaslight economic numbers. So while that continues, I think we'll continue to see weakening of the dollar. And I think it's partly also because of reallocation of assets outside the US. A lot of non-US fund managers in Europe in particular are choosing to move their money out of the US, and that's going to have a negative impact on the dollar. Next question is from Walking Madman. Okay. And the question is, can you share your thoughts on ETF WRDA given its 0.06% total expense ratio? I'm not familiar with that one, unless it's a variation of one of the ones I am familiar with. Oh, it's a UBS one. Okay, that's nice. Let's zoom in on that because the graph's a bit funny. So what is it? Let's have a look at it. So this is Yep, low fee, ongoing charge 0.06, which is I think what you said. And it's a global large cap equity fund. Let's just give the index here, the benchmark. No. Here we go. The objective of the fund is to track the equity market performance globally, so it's a global index fund. The investment policy of the fund is to seek to track the performance of MSCI World, so it's a developed market tracker. If it was EM as well, it would be called MSCI ACWI. Blah, blah, blah. There we go. So it's just an MSCI World Tracker, WRDA. Oh, I don't think we've got this on our cheapest funds list. So I'll add it. And the good thing is I can do that overnight. So for our members, we kind of maintain these lists of cheapest funds. So I can certainly add that. Is it accumulation? Yes. Does it trade in sterling? Yes. So it ticks a lot of boxes. It's been around for a while. You can see there's a bit of a pricing glitch there. But they're all much of a muchness, right? If it tracks a certain index, well, it's pretty much fungible. It's swappable for any other MSCI world tracker. So this would be a developed market tracker. Let's just see if it's in our cheapest funds list. I think it might be, actually. Let me make that larger. What we're also doing is creating a list of the cheapest platforms, which we thought would be useful. And again, this was part of the feedback in our members survey. So let's look at the cheapest funds, and we'll filter for UK funds and developed. Maybe we've already got it. You know, it could be I've forgotten. I'm getting on a bit. Yeah, at WRDA we've already got it. So it's certainly one we were aware of, but I'd forgotten about. LGGG is another one, which is the same fund management fee. This is the legal and general one. Again, it's an ETF. And another one, a new one, is this Amundi Prime Global Fund, which does trade in sterling, but it's an income fund, unfortunately. MWAS. And I think there is an accumulation version of it, but I don't think it trades in sterling. Fingers crossed. Let's go to Amundi. I accept everything. MWAS. Yeah, great. Cheers, Amundi. Anyway, yeah. So was aware, but had forgotten. Apologies for that. Yeah, so that's another one which you could use for your global equity exposure. And there'll be new ones all the time, right? So it's always worth keeping an eye on it. And don't feel any kind of obligation to, stick with a fund. There's no reason to do that. I think they are, you just go for the cheapest one, probably, given the exposure you want for a global index fund. But anyway, I make a video regularly about those. I'll probably make one again this year about the best global index fund for equity. So I'll be talking about those. And probably the developed ones as well, because they're kind of similar. Anyway, I think that's it. So I'll go back to your questions now. And those are all the super chats. Thank you for all the super chats. Those are great questions. And thank you for the huge super chat, Good Q. I really appreciate it. I think that's the largest one I've ever had. And you're a physicist by the sound of it. Even better. Great. Your questions, which I cannot find. Yes, I can. So how long have we got? We've got 5 minutes. We'll do a quick fire one. Dan Trainer says, we support Trump and his policies that the American people demanded. Yeah, this is what America wants. Doesn't mean what they've wanted is good, but it does mean that's what the American populace wanted. Whether they'll still want it once they see the effects of it, the economic effects, is another thing. Gavin Lawrence says, it seems the Europeans are now literally resorting to war to try and catalyse growth in the area. And I think that's a shameful thing to have to resort to. That's one way of seeing it. I think what's very clear is that Europe had underspent on defence and underestimated the threat from Russia for a long time. And if you look at GDP, if you look at spending on defence relative to GDP, it has been on a steady decline for some time, and people just assumed that peace would continue. So I think that's one of the benefits, which is that we've actually realised that we will have to spend more on our own defence and not rely on the US. Plus, there could be some technological benefits that come out of defence spending. After the Second World War, remember, there was a huge resurgence of technology stimulated by the defence spending, but also the technological innovation that went into war. There's an unfortunate truth that a lot of innovation does come from weapons development. So, but is it shameful? I don't think so. I think spending on your own defence is just sensible. Someone does a taco Trump trade. Okay, very good. I couldn't find any empirical evidence, Gavin Lawrence says, that defence spending produces long-term economic growth and prosperity. Well, I mean, there are certain technologies which have come out of war, and it's no question that those have been growth positive. If you look at Boeing in the United States, a large manufacturer of aeroplanes, it got a huge boost from the Second World War and building bombers in the Second World War, which then switched into developing commercial airliners. That's just one example. Computing power, building computers to crack codes, cryptography. A lot of the computing revolutions that we've seen are based on technology and knowledge, which went into that. Things like the Enigma machine. Those are brilliant stories. I love the stories about Bletchley Park, which is in Buckinghamshire. It's just north of us. I've always wanted to go there. Have to go and see it. Alex M. Hardly resorting to war for growth. Europe. US withdrew security guarantee. Russia invaded Ukraine. Where's next? And Europe not meeting their agreed spend as a percentage of GDP. Now addressing this. Yeah, I agree with that. I think that's true. Let's go to some more questions. Do we have any more super chats? I always miss one right at the end. That's what usually happens. But I haven't today. That's good. So back to your questions. Let's see if I can find a question. Ramin should be on the Mount Rushmore of YouTube investing. That's very kind of you. Only 3.5 years. That's optimistic. He's laying the groundwork for a lifetime in office. I think that's unlikely. Behind every successful man is a great woman. Yes, there is, and she's downstairs. Here's a good one. Gordon Ghetto. Good question. Good handle. Will gold keep rising? What percentage of my funds should I put into gold? I think gold has already started to fall, actually. So if we go back to the trackers, we do have a fundamental valuation model for gold, a kind of basic one. But if you look at the current valuation for gold, it's currently overvalued by about 23%, and it's been overvalued for a while. I think people are still worried about the US. If you look at the price of gold, a lot of Chinese buyers are putting money into gold. There was an article in the FT recently about Iranian people buying gold because it's not subject to sanctions and you can get it across the border in compact form without the scrutiny of foreign countries. So a lot of reasons why people are buying gold. A lot of it to do with the trade war. A lot of it to do with policy instability, put it that way, which is pushing up its value. Will it carry on going up? I think while the drivers are still there, yeah. Although it has got a little bit volatile and it is looking like it's lost a bit of its momentum. I mean, personally, I don't buy gold at the moment. I might do because I was thinking of doing one of these levered core strategies where you buy leverage 60-40 and then you overlay uncorrelated asset with it. So your £100 invested, you put 66% of it into a 1.5 times levered 60/40 portfolio, global equity, global bonds, and that means you've still got 33% or £33 to play with, where you can layer the return on top of the 60/40 portfolio. So the leverage is just there to give you a bit more wiggle room to invest and return stack on top of the 60/40. And people often put commodities like gold and broad commodities into the remaining 33%. So I was thinking of buying gold as part of that, but then what put me off it was the huge price of gold right now and its overvaluation relative to fundamentals. So, I'm kind of holding off on that one for now. I mean, I might buy it, I don't know, but certainly not for now. Could it go further? Yeah, absolutely. What percentage of my funds should I put into gold? You can't ask that. And I can't answer it because I don't know what your circumstances are or what your risk appetite is. But look, if you look at some of these famous strategies like the golden butterfly, it's 20% in gold. It is quite extreme, I think, 20%. But it really depends on, what's your risk appetite? Do you believe in these strategies which are diversified across different asset types? Are you in retirement and are you drawing down on your portfolio? And I think gold actually does make a lot of sense. But the percentage you should have in gold, yeah, that's completely subjective. Much more than 20%, I'd be pretty surprised. So if I was talking to a client and they said, I've got 30% in gold, I'd be a little bit shocked. That's a lot. Because gold's quite volatile and quite crashy itself. And at the moment, of course, we're on the back of this huge rally. And often what happens after that is a big correction. And gold can crash for a long time. In fact, if you look in real terms, I think we're still in drawdown from the 1980s, the 1982 peak for gold. Maybe that's not true anymore. It certainly was when we did a podcast about it about a year ago, I think. But anyway, look, we're past 8 o'clock now, so thank you all for joining us. Let me just double check there are no more questions. No, they're not. Super Chat says FWRG bid offer spread is 11% right now. Wow, okay, that is a shock. Is that right? That is shocking. Anyway, I'll look into that. Thank you for the Super Chat. I'll definitely look. I mean, if it's a small fund, often the bid offer spread is quite wide, but a 10%, 11% bid offer spread for what is a fairly liquid and fairly large fund, it's 24 billion, would be very surprising. I'm going to have to check that now. Is that right? FWRG. The JP Morgan funds are great because they actually show you the bid offer spread. FWRG. I'm assuming you're talking about the Invesco FTSE All World tracker, not the single stock in the US. But let's have a look at the prices. I don't think I've got bid offer spread data here, unfortunately. But if we look on the London Stock Exchange, you can actually see the bid offer. And after this, we'll end it. FWRG. Okay, London Invesco FWRG stock and bid offer 537538. So it doesn't look that big to me. That looks pretty small. 537. Maybe you've got the wrong stock. That looks like a bid offer spread of 0.2% to me. So I think it's okay. Anyway, look, let's draw a line under it there. Thank you for joining us. Remember, we've got this discount until the end of June. Did I mention that? Where you get 75% off our membership, off your first month's membership of our community. So June only. Use the coupon code save 75 when you're at checkout for our community. You can find that at pensioncraft.com/membership, and that's 75% off your first month. And then you get our bundle of 3 introductory courses, which you can keep forever, whether you cancel or not. And if you do stay with us, obviously you get all the other benefits. You get the chat application, members only videos, and a discount with My Finance Future, which is an incredibly good planning app, cash flow modeling app, so that you can plan your future finances if you're based in the UK. So lots of benefits. Please do join us. I look forward to welcoming you to our community, and good luck with your portfolio.